Hi, and welcome back to another edition of Lipper's Fund Flows Insight. My name is Tom Roseen. Thanks for joining me today. Mutual fund investors injected about $15.4 billion for the weekend at August 15th, 2012. Again, that's into the conventional fund business. And that's a lot of money, but actually investors took a breather this week. You know, after 5 weeks of plus-side performance, really they decided to kind of sit back on their hands and didn't put a lot of money back to work into equity funds. We'll show you a little bit more detail on that. The Dow Jones Industrial Average actually was able to post a 0.010% return, so just a little bit on the light side. But this is after we heard from Japan that their gross domestic product was about a half of what the analysts had originally expected, and a lot of people are sitting around in this wait-and-see attitude to see what's going on from the central bankers. So overall, you know, people again had some good news. We saw that the initial jobless claims were on the rise. We saw that June exports were actually at record highs, and additionally, that Germany actually came in with GDP growth actually about 0.3%, which was much higher than expected as well. But again, people were very concerned, and part of this is just that we're in the dog days of summer, and people said, hey, low volume, we really don't know what's going on in Europe, so let's sit back. Well, let's give you a detail on where flows actually went this week, and I'll give you a little bit more focus as well. Equity funds saw about $1.8 billion of money flow out of their coffers. Taxable bond funds took in about $2.9 billion. Muni bond funds saw a good number, 0.9, a little bit less than $1 billion in net new money coming to their coffers, and money market funds actually took in the lion's share of net new money, $13.5 billion. And again, a lot of this was done by institutional treasuries and the like. We'll show you that in detail as we go on. Well, equity funds really are going to be the focus here for this first part of the review. We saw that equity funds returned about 0.28% return. Nothing high. It's the third week in 3 that we actually saw, you know, plus side performance. But ironically, for the third week in 4, we saw about $1.8 billion in outflow. So again, investors are really quite shaky. They hear there's good news. They know there's been 5 weeks of good performance. We've seen some good adjusted beatings of as far as earnings reports go and the like, but again, this is off you know, a lower than expected you know, output, so to speak. But what we really saw was investors really concerned with this kind of malaise that we've had over the last several weeks as well with the market in low volume. Well, domestic equity funds actually saw about $2 billion in outflow, while non-domestic equity funds took in about $150 million in net new money. And this is the second week in a row that we've seen the non-domestic group actually taking money. Interesting, as we take a look at it, international actually saw some flows, but if we look a little bit deeper, we see equity income funds, these are dividend paying funds, taking about $159 million, and real estate funds, again, took in about $122 million. We've seen this over the last 9 weeks or so, that these two groups have been taking in a good portion of money. We've had a little bit of negative off and on there, but equity income funds, for example, 9th consecutive week of net new money coming into their coffers. Well, if we take a look at the ETF side of the business, we kind of get the same thing. We would actually seen bigger outflows. Remember I told you $15.4 billion into the conventional fund business. That was actually much smaller if we included ETFs. They saw about $4.4 billion in outflow. And the main pariah was SPY, the Spider SP 500 fund. Saw about $3.1 billion in outflow, while we saw the Russell 2000 IWM lose about $1 billion, just a little bit less than $1 billion in money leave their coffers as well. On the flip side, if we look at the very bottom, we saw that the select sector technology spider actually took in money, about $0.3 billion. So we see investors, even on the institutional side, you know, with this wait-and-see attitude, sitting back and saying, you know, maybe it's time to take a little bit of money off the table. And again, after 5 consecutive weeks of good performance, maybe they're just taking a little bit of profit off the table as well. Well, that brings us to another dividend or income paying type of security, and that's our fixed income funds group. Fixed income fund group for the 10th consecutive week saw net new money coming to their coffers, $2.9 billion in net new money coming to there. It was the first week in 3 that we saw a negative performance, though. They were down 0.20%, just a small decline. But investors, again, were going after yield. So they're willing to go out on the risk spectrum to get a little bit more yield. We saw that the corporate investment grade debt funds took in about $1.2 billion. This is the 9th consecutive week that they've seen net new money come in. We saw that the corporate high yield funds saw about $464 million in net new money as well. So really the story is investors are, again, maybe diving for safety, but in particular when they are, they're looking for yield. So they haven't been putting money in treasuries. And how we can support that statement is if we look at the ETFs as well in the fixed income universe. Now, ETFs are a very small universe in fixed income. So when we see low inflows, $132 million into this group of net new money, that's not unusual because, again, it's just a new burgeoning group. Again, fixed income funds have just come in the last several years to be a popular asset class into ETFs. But flexible portfolio funds, flexible income funds actually saw $343 million in net new money. And in particular, if we take a look at one of the loan par groups, iShares, senior loan funds, basically on the ETF side, saw about $56 million in net new money come in. And at the very bottom of that group, on the ETF group, we saw treasuries at the bottom. So again, investors have not been necessarily playing into treasuries when they've been diving for cover, quote, but basically going after yield. And this has been a very important aspect over the last several months. People looking for dividend and increased yield anywhere they can get it. Well, that brings us to muni. The muni funds actually for the second consecutive week saw negative performance, down 0.25%. But for the 18th consecutive week, they've seen net new money come in. This was almost $1 billion in net new money coming into their coffers. Interesting enough, if we take a look at the 4-week moving average, that's been on a steady increase as well over the last several weeks. So investors are obviously seeing something that other investors are not. The New York Fed came out and said, hey, listen, there's been a heck of a lot more defaults than was previously reported in Moody's. A lot of people are saying, well, that's true, but that was unrated debt. And so it's something that people have been going back and forth. We'll have to see if that impacts muni bond fund flows. But for instance, national munis took in about $838 million net new money. And certainly when we took a look at the yields as of Wednesday, we saw that there were many higher yields, tax equivalent yields, beating out their taxable brethren in this group as well. So we think that money will continue to flow in here as long as we still see superior yields coming out of this group. Well, that brings us to one of the lower yield categories, and that's money market funds. In some ways, people are saying, why on earth would people put money away into work into money market funds? And I think it's opportunistic. They're taking money off the table, letting it sit on the side until they can do other investments. We saw that money market funds actually took in $13.5 billion this week, second week in 3 that we've actually seen inflows. And if we break that down, taxable money market funds saw $14 billion net new money. And here's the difference. Institutional investors put in about $13.1 billion, while retail investors only put in a little bit shy of $1 billion. It was $0.9 million or $900 million. Tax-exempt money market funds, though, saw a slight outflow of about a little less than $500 million as well. So we see investors actually putting money away. The general question, is there a trend? Certainly we could point to, people maybe preparing for quarterly payments or taxes or the like. But really, I think this is one of those things where people are sitting on their hands. They've moved a lot of money out of ETFs, and they just need to place to target for a short period of time before they put it back to work. Well, if you want to do a deeper dive and do an analysis deeper than what we've provided you here, certainly you can go to LipperUSFundFlows.com and get a greater detail from that group and get a lot more, again, detail. Or you can come and join us next week where we'll provide you a little bit more about flows, and one of our analysts will talk to you about the trends at that time. Well, until next time, my name's Tom Roseen, wishing you the best in your wealth planning and creation.